Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment market so you can understand what we see in the global landscape. Of course, second quarter is over. We've started third quarter, and earnings for the second quarter are starting to come out. In fact, if I look across the landscape, generally speaking, earnings are looking again pretty good. I'm expecting earnings to grow somewhere, let's say on average 8% this year. In the U.S., other parts of the world a little bit more and some a little bit less. But generally speaking, earnings in the U.S., I expect to grow around 8% this year. What does that mean for the U.S. equity markets and the U.S. economy? It means that things are growing. Remember, equity prices often follow earnings. So if earnings continue to grow, not contract, we could actually see quite a bit higher stock prices over the next 1, 3, and 5 years, as long as, again, earnings continue to grow at a normalized pace. And 8% actually is not bad in a slow growth economy, where right now we expect GDP around 2.5%. So again, the world's not coming to an end. We currently see no recessionary indications with all of our indicators that we look at Resney Wealth Management. We are fully invested. We're in relatively stronger asset categories that we deem to be important in our client portfolios based upon our strategy. And again, earnings are growing. Equity prices often follow, not a guarantee to the future, but this is often what has happened. While I like to talk about the news that's out there quite a bit, the fact is most investors should ignore most of the news that you hear, because most news is really just noise that makes investors make bad investment decisions. At Resney Wealth Management, we really take into account really none of the general news services out there that basically hype up a lot of the either negatives or positives with the news. We look at the hard data, and what does that hard data tell us? It tells us the economy is improving. The problem, again, negativity sells in the news. People listen to too much negativity, and they think the economy is not doing all that well. In fact, I expect the second half of 2014 to be stronger GDP growth, of course, than the first half of 2014. This should bode well for equity-based investors. One of the areas of big concern at our firm as I continue to look at interest rates where the 10-year hovers around 2.5%. I firmly believe, based upon Janet Yellen's testimony and her notes from the Fed meetings, that over time, rates will slowly move up. This is going to hurt traditional bond investors who are in individual bonds, corporate bonds, whether it's bond funds, ETFs, or individual bonds. It's going to hurt them if your duration is longer than, in my opinion, 1 to 2 years. Because as rates rise, bond prices fall. Again, we're at about a 2.5% on the 10-year. That's an important metric that I would watch. It has come down from 3% from the beginning of the year, so that's helped bond investors a little bit. I believe give them some false sense of security. But I think the second half of the year, if it's as strong as anticipated, I think bond investors are going to be hurt. I'm glad to say at our firm, we're on the right side of the bond market. We're in floating rate securities. We continue to believe that's the place to be for fixed income. If you're a client of our firm and you have a question, call us. If you're not a client of our firm, maybe it's time you became a client. Call us for a consultation. There is a difference. We invite you to experience it. Have a safe and profitable day.